Good morning, good afternoon, and welcome to our webinar on trade surveillance, market abuse, costs, compliance, and COVID. I'm your moderator, Lisa Regan, Head of Enterprise Sales for EMEA at Refinitiv LSEG. I'm based in Paris and I'm joined by our panelists in London and Frankfurt this morning. Welcome, Dr. Heike Dengler, Head of Market Conformity at UBS. Heike has over 20 years of experience in the capital markets, working within the sell side in both trading capacity and research, as well as on the buy side, managing fixed income and balanced funds. Heike has an extensive experience in building trade surveillance systems and working within the consultancy and audit fields of market and liquidity risk. Welcome to Chris Whitaker, who joins us from London. Chris is a senior associate at DLA Piper, advising clients on UK and European financial services laws, including the Financial Services and Markets Act 2000, the Payment Services Directive, the Alternative Investment Funds Directive, the Market Abuse Regulation, the UK Senior Managers and Certification Regimes, alongside MiFID II. Prior to moving to London and into private practice, Chris was based in Australia and worked for the ASIC, where he investigated and litigated financial crime matters, including insider trading cases. And finally, welcome to Stefan Queck, based in Frankfurt at bNext. Stefan is Head of Sales from bNext, whose solutions cover market abuse surveillance, best execution, adverse media screening, sanctions list monitoring, e-commerce surveillance, to name but a few. Stefan at bNext, their clients span global, and he has extensive experience in next generation product development. Before we get into the topic today, there are a few housekeeping notes that I did want to mention. There will be references throughout this webinar to various reports, notably the Thomson Reuters Regulatory Intelligence Q1 2020 report. The Thomson Reuters report has unsurpassed breadth, depth, and quality of regulatory intelligence, with global coverage of over 1,000 regulatory bodies and more than 2,500 collections of regulatory and legislative materials. Please note that all references are available at the end of this presentation. For those interested in learning more on how Refinitiv services the compliance industry with our partners, there will be opportunity for follow-up post-webinar. This webinar does not contain a product demonstration. Lastly, there are several references to the FCA in the prepared remarks as authorised by Julia Hoggett. Julia is the former Director of Market Oversight at the FCA, but I'm delighted that she is now part of the LSEG Group and is CEO of the London Stock Exchange, PLC. The remarks are intended to be taken by this audience in a wider context and not solely applicable to the FCA, but the approach to market abuse and trade surveillance in general to ensure clean and efficient capital markets. Now, without further ado, let's get into it. So for discussion today, I'll be discussing with the panelists around the challenges that the firms within the financial industry are facing when it comes to trade surveillance and market abuse monitoring, particularly since the explosion of remote working and the evolution of the compliance priorities in 2021. How innovative technology is helping us to feed machine learning, data analytics, and reliable data are helping regulated institutions manage their compliance costs, needs, and future direction. And finally, we'll have a look at some of the headline media cases that we've seen in the past 6 to 12 months, including some of the comments on various different blogs by some of the participants on the webinar. So to go back to the first remark or the question around the challenges firms are facing, for the sake of this webinar, the compliance cost and operational implications are in relation to taking a holistic and non-exclusive view of the various components of trade surveillance and market abuse across the multiple rules and obligations as outlined within MAR, MiFID, AML, issuer listing obligations, etc., to ensure a market integrity in order to combat financial crime and market abuse, so that all elements of the capital markets chain play their critical role in the appropriate functioning of markets. Whilst the market abuse regulation came into effect on the 3rd of July 2016 to meet the compliance needs of listed companies, advisors and financial firms, according to the Thomson Reuters regulatory report of Q1 2020, over 71% of firms are in the process of upgrading their trader surveillance systems. And global expenditure on trader surveillance is increasing, averaging at $10,000 per employee. We see the development of specific work from home policies as top priority within the compliance agenda for 2021. Chris, can I turn to you with your vast experience in this domain? What are your thoughts on how the industry has evolved since the introduction of MAR? And is there a risk that somewhat we would neglect one's obligations relative to money laundering risks and vulnerabilities within the capital markets at the behest of MAR, particularly in relation to personal and individual accountability, which has been accentuated perhaps by working from home? Society has now evolved to accept home working as a functional operating model, but what are the risks that this may introduce now and in the years to come?
Thanks very much, Lisa, and good morning, good afternoon, everyone. It's a pleasure to be here. As Lisa mentioned, the Market Abuse Regulation, or MAR, has been in effect in the UK since July 2016 and has recently been onshored, so will continue to apply despite Brexit. So UK MAR is the regulatory framework for prohibiting market abuse and prohibits insider dealing, unlawful disclosure of inside information and market manipulation. It also in the UK empowers the FCA to do various things, such as supervise, investigate and sanction firms and individuals. So Lisa, you mentioned, how is it going in practice and how is the industry responding? Well, the prior regime before MAR was fairly well understood, and we had a regulator that was prepared to provide quite detailed guidance. Now, that was rolled back. For instance, the FCA removed its code of market conduct when MAR was introduced. So we lost a little bit of regulatory guidance in this space, but we did gain conformity with the rest of the EU at the time. But I would say that the MAR framework now is working fairly well, and it's quite well understood by industry participants. I think the rules about discharging managerial responsibilities and disclosures are fairly well understood, although I have some experience with clients who have found the market sounding regime in MAR to be quite clunky. But as you were saying, Lisa, I think going forward, the challenge for UK MAR is whether this regulatory framework is fit for purpose, given how our working lives have changed as a result of the pandemic, or actually I would say that perhaps instead of our lives have changed, some of the existing trends that we were seeing in our working lives have been accelerated as a result of the COVID-19 pandemic. So for example, as you mentioned, home working and the increased use of unmonitored and or encrypted communication apps like WhatsApp, where potentially sensitive information can be shared, has increased the risk of market abuse. The FCA in its recent Market Watch 66 publication reminded firms that they still have obligations to record communications, including electronic communications under CISC 10A, and it doesn't matter that the nature of communications have changed. So this is going to be a challenge for firms, no doubt, going forward. And also another challenge is the blurring of our personal and our work lives, which the pandemic has further accelerated as well. You also mentioned money laundering risks and vulnerabilities in capital markets. The UK has implemented the 5th Anti-Money Laundering Directive into UK law, and a whole range of firms are subject to registration and customary due diligence requirements and suspicious activity reporting. But I don't see AML obligations and MAR as a either-or situation, or that firms should trade off their obligations under each of those regimes. Essentially, they are two separate regimes with a degree of overlap, but both need to be complied with going forward. But it does make sense when you think about how you're going to comply with these two regulatory regimes to think about comprehensive, data-driven systems that can cover the ground. And not just in the AML and the MAR front, but you also need to be thinking about sanctions, and that's a very active space right now. The UK, as recently as yesterday, subjected certain entities and individuals in Belarus to the UK sanctions regime. So lots to think about there, but that's some initial reacts.
Thank you, Chris. And interesting, as you mentioned, WhatsApp, because I think in everyday life, people just see it as a given that that's a tool that we can use and access, both as we blur the lines from the personal to the professional life. And I think that at the beginning of the pandemic in Europe, in any case, it was kind of used as a de facto communication source, which now obviously needs to be scrutinized further. Heike, maybe I can turn to you in terms of the sourcing question and the operational execution since the pandemic really hit here in Europe in March 2020. Within, again, the Thomson Reuters compliance report, it was flagged that over 34% of firms are considering outsourcing. Some are part of their compliance functionality, which was up from 28% in 2019. And some of the reasons cited were around the lack of in-house compliance skills and the cost. How are you managing the sourcing of capable persons with the need for highly prolific risk profiles, like Chris said, not just to do a tick-the-box exercise, but really to take the holistic approach across mitigating all of these potential risks?
Yeah, thank you, Lisa. Thanks for having me and the question. As we're building the system to a large extent, I do face a lot of talent search. And we also do outsource, also within MCC, but we're not at a stage where we can outsource the whole lot, as you mentioned, because it needs deeper understanding of the market and of the business model, mainly of the company, to do the market conformity check on a solid basis. And that has to do with the changing marketplace, increase in trading on the one side, but thanks to a lot of central bank buying, drying up market, less liquid markets on the other side. And depending on the deal store infrastructure of the company you're in, there might be also a lot of interfaces one needs to deal with, understanding which trade is traded on which platform and combining the various platforms and adapting the control. So all of that needs an in-depth knowledge of A, the product, and B, the business model, and that is not tick the box, and it cannot be found off the shelf, basically. So how do I deal with that? In my personal line of business, market conformity, you need the mathematical skills, but you also need the product skills. It is very difficult to hire both, so I tend to hire either one or the other and teach whatever is missing.
So it's all about finding the balance, and as you stated, the balance can sometimes be challenging because people are expert in perhaps one area. But I suppose, as always, if people are willing to learn the other side of the fence, then you will have the best type of skilled people to be able to take that holistic approach and mitigate those risks.
And absolutely,
Stefan,
and I think that's how you... Oh, sorry, go on.
Go ahead, please.
No, I just wanted to say that's how it also turns out to be a win-win situation, because very often the talents are actually eager to learn the other side, and in the right business line, they have the opportunity, and that makes it a bit easier for me then.
Fantastic. Thank you, Heike. And Stefan, maybe I can turn to you from a solutions aspect. I mean, sitting outside of and seeing a variety of clients, what kind of methods are available to the industry through firms like yourself, and how have firms like yourself evolved in terms of the behavioural signals that we would look for to indicate exposure? And then I suppose more generally within your industry, what kind of evolution have you seen over the past 12 months with regards to making available solutions that are not just fit for purpose within the office, but also accessible and fit for purpose in a work from home scenario?
Mm-hmm. Yeah, thank you very much. So the main driver we see in the market is really cost for applying sufficient surveillance technology and use this company-wide. We see very often things like multiple asset classes needs to be covered, multiple locations and multiple jurisdictions, plus new regulations comes to the table each and every day, and the regulators invent more and more things that needs to be solved. And what is available in the market is data analytics for compliance. This is something that we see can help to solve the problem. And we have divided this into two main areas. One is digital infrastructure, and the second is a digital regulatory response. What do we mean? Digital infrastructure is the way how I deal with this requirement. We talk about automation. Automation helps to reduce operational costs. The more processes are automated, the more the contribution to the operational margin can be to improve the margin. Scalable cloud solutions are important to deal with higher data volumes. Cloud solutions are available, and it means also that there's an advantage if data volume increase. This can be managed immediately, and the costs associated with the cloud solutions are flexible. It breezes with the business volume. The third aspect in terms of digital infrastructure is a quick rollout to new regions. This comes also with the ability to configure systems in a multi-tenant way, to being able to react quickly to roll out to a new business in a new region just by setting up a tenant and not do the installation again. And this all, of course, is something where the support of working from home environments can also be made available. Remote access is the new normal, and this means a very much seamless and very important secure communication with employees. And this is something that we see in the market as the main trend. The second aspect is the digital regulatory response itself. So the first thing here is a flexible way to integrate data is key, not just staying with one set of data for a certain asset class, for example. The more flexible a solution is, the more can be covered on a single platform. It includes the activity data, trade data, all the activities of a bank. It also includes reference data, third-party data, market data, news data, and so on, as well as contextual data, e-com information, as well as macroeconomic data will help to solve this problem. And a solution that comes as a platform and not as a siloed solution where one regulatory need is covered is also contributing a lot to the cost aspect. So there's no need to run multiple systems in parallel. You can use one platform and just add more data to apply more analytics. Multi-tenant capabilities, I mentioned this already, is also a good response to regulatory needs due to the ability to configure independently based on individual requirements in a jurisdiction. And the flexible configuration of rule sets and analytics to include new asset classes is also contributing a lot. And this all together combined with intuitive visualization, which are used to reduce the workload each and every day for the surveillance analysts, and delivering a behavioral insight will help to get an overview. And all this is, of course, supported with adopting new technologies we see at the moment, machine learning, for example, which can be used also to reduce the workload each and every day, which has an impact, a positive impact on the cost.
Well, a lot in there, Stefan, but what I'm hearing is the platforms need to be able to tackle and address basically any of the aspects, again, to be able to have that holistic view. And then, of course, the key to all of that is having the data and reliable data. And of course, the challenge is with regards to the more illiquid side of the market, as Heike alluded to, and certainly the access to that information and whether or not it has lived up to expectation, where regulations like maybe MiFID II, we would have expected to increase transparency into the OTC or fixed income market, the derivatives market, to be able to add additional elements into managing the obligations around market abuse and trade surveillance more generally. So with that in mind, I'd like to put in the first polling question. Just a note to the audience, we've allocated some time towards the end of the presentation to be able to address Q&A. So do please feel free to put in your questions and challenge the speakers, including myself, on the chat, and then we will review those towards the end of the session. So this first polling question, there are 4 polling questions in the session today. The first polling question is, what do you see as the main challenges of monitoring trade surveillance? Automation, access to reliable data, sourcing of competent risk profiles. So I'll just give that a moment so that everyone has a chance to be able to participate. We're seeing, so I'm just seeing some of the polling results. Well, it looks like access to reliable data is definitely out in the lead. Automation is gaining headway on the access to reliable data. And it looks like sourcing of competent profiles, only about 16%. So I'll give it just another moment, let the audience provide as much insight as we can on this one. And maybe we'll call it time there. So if you can see the results. So what do you see as the main challenges of monitoring trade surveillance? 66% of the audience have responded to access to reliable data. I'm not sure I'm that surprised by that, considering the topic raised around the transparency that has been provided or not on fixed income, on commodities, on equity derivatives, and how that has fed down into the compliance conversations. Automation, interesting to see that that's coming in at 32%. And then, of course, the sourcing of competent risk profiles. So interesting results there. We shall move on to the second topic that we wanted to explore around how innovative technology, so obviously AI, machine learning and data analytics, can provide reliable data and are helping the industry manage the compliance costs and the needs for the future direction of investment and operational strategy. So we've seen from Chris with regards to MAR, the introduction of MAR and other safeguards, including, and as I've mentioned before, MiFID II, that it was expected that there would be an increase in transparency outside of the equity landscape. And I mean, our polling question really points to this, in that one of the largest challenges across the industry is the access to data. And of course, I'm sure that the audience members are referring to the fixed income, commodity and non-standard derivative markets. So I suppose the first question I would put out is, has MiFID contributed to the increased transparency for non-equity markets, enabling better AI, machine learning, and identifying possible abuses? In my conversation with Julia Hoggett, she mentioned to me that they had done a study at the FCA that if they were to be able to use artificial intelligence within those markets where there's less liquidity, they would basically have to go back to the 17th century to be able to train the AI to identify possible abuses. So obviously that's off the cards for the moment in any case. So it's really, how can we train machine learning better to inform us as humans to be able to detect the behavioral signals that could indicate a risk when liquidity really is an issue. And I really enjoyed reading a recent paper by Ernst & Young where they've coined the phrase of the ABCD of surveillance: A for accuracy, B for breadth, C for culture, and D for data. And I mean, I think from the outset of this discussion, we've really pointed to the fact that we can't have just a tick the box exercise, and we have to look at the overall holistic picture to ensure that we're engaged in the right tasks to understand, identify, and mitigate risk accordingly. I suppose, as Julia mentioned to me, she said, it's better to understand what is the nature of my business and what is the nature of the surveillance that I need to deploy, as opposed to a rules-based unique reporting, as this won't be the complete answer to managing risk. Or as Rob Stubbs, from the head of research at Chartis, is quoted as saying, firms have a new realism about what technology can achieve, paying more attention to using the right tools for the right use cases on the right platforms. So Heike, I mean, I don't think there's a silver bullet solution. What is your experience on the ground in collating and accessing and leveraging artificial intelligence, and I suppose using the different tools that are available to you, either off the shelf or or in-house built tools, to overcome the operational challenges in monitoring and implementing your strategy to mitigate the nature of the risk?
Thank you. So I also believe that automation is the way to go, and I actually do that. Artificial intelligence, for all intents and purposes these days, is very often a regression, so we shouldn't overestimate the benefit artificial intelligence can give at this very point. Nevertheless, going forward, I strongly believe we have that there is synergies. At UBS, we have a very strong team in finance dealing with artificial intelligence, and we will find synergies going forward and blend in. So that's the way I'm going on that one. And on the automation part, it is really building the right infrastructure, or building the right machine, as I say, to deal with as many trades on an automated basis as possible. I certainly believe that is the way to go. And you also need very trained and skilled people to do that.
And so we go back to the resourcing topic that we mentioned in the previous point. Yeah. And because I mean,
my experience from UBS and other companies is, where I was as a consultant, that depending on the business model, it might be very difficult to find the right fit off the shelf. So very often you are reliant on building a lot of routines yourself within the company.
So it's really a case of a mix and match of best of breed, what's off the shelf, and then the in-house build. Chris, maybe I can turn to you to ask and comment on what's the view of using and leveraging artificial intelligence from the regulatory community, and generally how can clients mitigate the risk which is inherent in illiquid markets in the context of market abuse and trade surveillance?
Sure, thanks, Lisa. I mean, I think when it comes to UK regulators and AI, particularly the FCA, UK regulators are very much in a listening and learning mode right now. I'm aware that the FCA has partnered with the Alan Turing Institute, and it's undertaking some joint research on the impact of AI on financial markets. What's also noteworthy in this space is that the FCA and the Bank of England have published a thought leadership piece on machine learning in 2019, and then they've recently established what they call an AI public-private forum to better understand the use and impact of AI and machine learning in financial markets. And I think this will be very interesting given that the polling result was talking about access to reliable data, because the latest minutes of this forum are available online. The meeting was held in a very whole range of discussion about the quality of data, access to third-party data, data standards, etc. So all of this feeds into some of the considerations that we're seeing. And the minutes of that forum also point out that the regulators, in discussion with a number of private sector organizations, are also discussing data ethics, for instance. And they've made reference to the European Commission's ethics guidelines for trustworthy AI. So this is some interesting things like human insight and must always be required when it comes to AI governance. AI should not be presented as human to customers, and AI going forward could be itself a stakeholder when looking at other AI algorithms. So very interesting stuff there. Regulators as well are thinking about how they can use AI and machine learning. So the UK Prudential Regulation Authority, the PRA, is actually looking at converting its rule book into being machine readable going forward, so as to make use of machine learning tools to enhance the capacity of its supervisors, and also for industry itself to be able to plug in rules into systems. So I think we're seeing at least some learning, some open-mindedness from UK regulators as to how they can use AI and machine learning going forward. Now, your second question, Lisa, is the more tricky question. Certainly, we can't go back to the 17th century, and we are hamstrung by the lack of quality data, particularly in the OTC space. But it's worth pointing out that the regulatory rules and restrictions still apply. So, for example, the trading of financial instruments in non-liquid markets, in the FIG space, are all subject to the same market abuse restrictions. And so firms really do need to figure out what the best approach, the most efficient approach is to getting quality data, monitoring transactions, and then undertaking their reporting obligations.
Thank you, Chris. And I really like to see that you use the word open-mindedness, because it's true that I think, 2 years ago, artificial intelligence in itself seemed to be this very far off, distant idea of some people in maybe Silicon Valley or such like. And really it's become a kind of a mainstay in everyone's life now, from, robo-type advising to leveraging artificial intelligence to be able to, process such amounts of data and come to conclusions. But I do like the fact that you mentioned that human integrity has to be there. So for the moment, we all still have a job and a value to be able to help artificial intelligence really help us do our jobs better and ensure clean and functional markets. Stefan, perhaps I can turn to you with regards to your observations over the past 5 years on how firms have been leveraging technologies to ensure how they can detect behavioral change. And with regards to BNext, what do you see is the anticipated future of the solution and perhaps the integration of leveraging AI?
Yeah. So what we see here is a bit of a shift coming from static rules, predefined rules, searching for certain things, but not getting rid of these rules. It is more combining rules and apply additional machine learning capabilities, which are used to learn new things or focus more on pattern repeating over time. So it helps to make surveillance more efficient. It helps to focus on certain things. At the end of the day, we see also that the automation of this analytics part is helpful. But the decision at the end of the day, how to deal with certain alerts or signals detected, should not be fully automated. This is something where we still see manual interaction needed. But machine learning can help to get the focus on the right spot. And this also combined with integrating more data, more contextual data, which are blended over the trade activities to get a more context, will also help to make the machine learning process more accurate. The same comes for alert management. We also found out that applying machine learning to learn from users how they interact with alerts may help to pre-categorize some signals detected by the system into risky, less risky, or potentially false positive alerts just by replicating decisions made by the users in the past. And this is also an area where machine learning can help to reduce the daily workload. And it means that all these things is something that we see can be made available and is made available by providers. We see some companies starting to develop this in-house. There is, of course, not a clear picture which way is the best. I have the impression that it would make sense to leverage a learning curve some vendors have made already and not start again always from scratch with own concepts and own test activities over time. And what we see as an ultimate goal as well is this could also lead into a new, let's call it, part of surveillance. Benchmarking the own activities today against the own history will help by getting informed by a machine learning algorithm if there are changes in the behavior. But why not also thinking about into the future, comparing my results against peer groups, some other financial institutions, for example, willing, for instance, to make some anonymized information available to compare things against, to also increase the information for each individual surveillance analyst.
Well, a lot there, but definitely we're going to see the acceleration of the use of artificial intelligence. But I think, the key point is the artificial intelligence is only as good as we can make it by making the data available, and definitely for specific asset classes that is still a challenge and requires a specific type of competency as well to understand it. To Heike's point earlier. I think we have another polling question coming up. This next polling question is, does your company use an off-the-shelf solution to identify potential anomalies? I suppose we could have had a third option there to say in-house or 50-50. So I'm sure that the majority of the respondents will say yes, but that should be maybe taken into the context of being a combination of off-the-shelf plus in-house build as well. So we'll give that a moment as we transition into the third part of our conversation around the headlines and the media. And of course, we all know that the media, both on the internet and on traditional broadsheet type media, are quite sensationalistic sometimes in their headlines. But if we look at recent headlines, and when I'm talking about recent, I mean it's articles even that have been published in the past month or 2 months or so, we are seeing, whether justly or not, a spate of activity around crimes such as insider dealing and engaging in market abuse. And the media seems to portray that this is a result of COVID and the inadequate systems and controls preventing a firm from identifying and reporting suspicious activity. So when I look at one of the articles, and we'll leave that polling question to just another moment while the audience completes. And when I look at the article from the FT Advisor on the 16th of February, they're quoting a white paper from Trading Hub where Trading Hub is mentioning an increase of up to 40% of market abuse within the asset management industry at the end of 2020. So comparing that to pre-pandemic levels, this is a very significant increase, and they're making the assumption that this is based off of the management of working from home and putting in place the safeguards around working from home. And as Chris alluded to at the opening, remarks around potentially using maybe WhatsApp or methods such like. And when Trading Hub, who they monitor the risk of abuse for around a quarter of assets globally, they rated the red flags for the buy-side institutions did accelerate over the period versus the sell side. So does that mean that the sell side has better mitigated some of the aspects of the lockdown more robustly? And when you look at before the coronavirus crisis in Europe, just over 4% of transactions were setting off alerts. And this shot up to nearly 9% when we started to work from home. However, at the turn of the year, the market abuse risk was still 40% higher than the beginning of the year, with close to 6% of transactions raising red flags. So that leads me to ask, are there specific actors which are more vulnerable than others within the industry? And according to a survey done by Chartis, they believe that the buy-side firms prefer to acquire tools from vendors with one or all of the following packages, in that pre-existing pipes, connections and networks with strong intellectual and cultural heritage to be able to provide pre-packaged data and analytics. So with that, I want to explore with you, Chris, in terms of what is the view on these high-profile cases, and particularly in reference to a recent blog that you published with regards to the trends on social media and new assets such as crypto, and also looking at the responsibility of the investment choice shifting from institutional to individual retail investors.
Thanks, Lisa. Lots to unpack there. But the starting point, I think, is that we have seen increased retail investor involvement in financial markets, and that has necessarily meant that regulators are looking very closely at what is going on in markets. So in 2020, we saw a very strong increase in the opening of broking accounts, and we also saw a number of dormant accounts being reactivated. And it's estimated in March and April of last year that 20% of the volume on the FTSE was retail investors, 60% of their orders being buy orders. Now, the concern perhaps imported from the US is that we've seen social media and the new forms in which we communicate becoming a very large driver in investment decisions. And there are a whole range of potentially vulnerable retail investors who can be swept up in Reddit pump schemes for GameStop and AMC Entertainment, which we've seen. And some suggestion that some of these investors have acted in a coordinated fashion to enact what's called a short squeeze on certain stocks. And this is at a time when AMC is warning the market and its own investors not to buy its own shares. So we're seeing, if you will, some irrationality creeping into the market and potentially some very vulnerable customers who will be left out to dry. So regulators essentially have three options in their toolkit. The first is engaging in investor warnings. The second is a more interventionist approach where they start banning products or intervening in markets. And the third is enforcement action. So I might just briefly touch on those three topics. Firstly, when it comes to warnings, regulators like the Australian Securities and Investments Commission have warned activist short sellers about what practices constitute market manipulation, and also has tried to be proactive, put out there some best practices for what activist short sellers should be doing. And that's also, for example, when they're issuing reports, not using overly emotive, intemperate, or imprecise language, whether on social media or otherwise. In February of this year, the European Securities and Markets Authority published a statement noting very high volatility in certain equities trading based on social media initiatives. And ESMA cautioned the market, brokers and retail investors themselves when it comes to this type of trading. The opportunity, of course, to buy and sell can be discussed online without that constituting market manipulation. But ESMA noted that there's a very fine line, and that coordinating or organizing strategies online to trade or place orders at certain times or under certain conditions could constitute market manipulation. So we've got the warnings from regulators, but what we're seeing now as well is that regulators prepared to roll up their sleeves and engage in more market interventions. So going back to 2019, for example, the European Securities and Markets Authority, ESMA, and the FCA both intervened in the market for contracts for difference and put in place various restrictions on retail investors in their ability to trade certain CFDs. And so really what's happening there is that the FCA is prepared now to say some investment types are not appropriate for retail investors, and we will stop investors having that choice in the marketplace. The FCA also recently, as of the 29th of April, has published a discussion paper on strengthening rules about financial promotions for high-risk investments so that retail investors can make better decisions. And this is an interesting point, again, going to what Lisa was saying about investor choice. Essentially, in this discussion paper, the FCA is saying that some high-risk investments are inappropriate for retail investors, and so should be separated out from more mainstream markets. So here I'm referring to things like non-readily realizable securities, peer-to-peer agreements, non-mainstream pooled investments, and very speculative illiquid securities. And there are regulators in Europe, at least, are under some pressure here when it comes to payment for order flow. There is a concern that some of the more retail-focused brokers, the discount brokers or zero-commission brokers, are pushing order flow to only some trading venues. And the Federation for European Securities Exchanges is saying that that's actually a breach of these brokers' MiFID II best execution obligations. So the first is warnings. The second is product intervention. And it's also worth noting that regulators will take action here when it comes to protecting retail investors and upholding market integrity. And an interesting one, which I thought worth mentioning today, is that the FCA was recently successful in March of this year at the UK High Court, taking action against an organisation called 24-Hour Trading and its operating executive. What 24-Hour Trading did was send so-called market signals via WhatsApp messages to its retail investor cohort. It claimed that it was an educational organisation, but the High Court and Mr. Justice Richards essentially concluded that what they were doing was providing unlicensed investment advice to vulnerable retail investors. So enforcement action, and particularly as well in some of the themes that we've discussed today, enforcement action in our changed work environment with the use of mobile encrypted apps, the regulators are certainly in this space as well. So those are the kind of three ways that regulators, I think, are tackling some of these issues. The last point you mentioned, Lisa, is crypto. And look, there's a whole range of issues in the crypto market. Worth noting that cryptocurrency itself is not a financial instrument, so is not subject to MAR. Unlike a number of other instruments beyond equities, certainly in the fixed space, are financial instruments. So that means that there isn't a robust market integrity-focused regulatory regime for cryptocurrencies. Certainly, cryptocurrency participants, businesses, need to be registered for AML purposes, and they have custom and due diligence requirements and suspicious activity reporting obligations. But it is a risky area for retail investors. And so in terms of regulatory actions, what we've seen so far from regulators is a whole range of warnings about investing in that space. So that's a quick run through of what we're seeing in the marketplace in response to some of those high profile market abuse incidents.
Thank you, Chris. And whilst we've only skimmed the surface, I mean, we can see the speed at which the market and the regulators need to adapt with regards to the new technologies and ways that firms are accessing the retail market, and those assets that are not yet included under such regimes that are also high-profile assets and create vulnerabilities, like you say, and exposure to the individual investor community. I'm conscious of time, and the time has flown, so we're going to quickly look at the results from the previous polling question. Nothing really surprising there in terms of almost 70% of the respondents have confirmed that they do have an off-the-shelf solution. I'm sure that solution is complemented, as we've discussed in depth here, around additional in-house solutions with human insight. And we do have a third polling question, so I'm going to post that. And this is in relation to the stores. So has your firm experienced an increase in suspicious transaction and order reports, as was alluded to in some of the press articles that I cited, since March 2020? Of course, the increase in the number of stores doesn't necessarily point to the increase in abuses per se, but it does indicate potentially that people were being much more vigilant, perhaps with the increased volatility as well that we've experienced in the market since 2020. And of course, the Q&A is still open. I'd like to engage a little bit now with the audience in terms of asking whether or not you feel that there are specific actors, be them brokers, be it the buy side, be it the sell side, that are more vulnerable than others in relation to the transition from working from the office as standard to working from home over the past 12 plus months, and whether or not that has created a significant pressure within the management of the compliance and risk obligations. And also, if you've seen an increase in the diversity of solutions that are available to the industry as a whole. So I'm going to post those questions in the chat. I'd appreciate the audience members to participate as well actively. And whilst I'll do that, I'll also ask Heike, from your experience, which is quite varied across the buy and the sell side, and also within the audit experience, do you think that there are specific actors within the market that are potentially more vulnerable than others?
Specific actors? Yeah.
Yes.
I would say that the more complicated the business model is, and the more there is to control, the more vulnerable you're also at the end of the day, right? Depending on the kind of products you use, and also touching on the previous topics, how much of it is automated, how much you use algo trades, etc. The more there is to do around controls. And I think the vulnerability comes with complexity at the end of the day.
So that complexity equation. And for you, Stefan, have you seen an increase in the diversity of the firms that are looking to you and to be next to provide solutions? Would you see a trend increasing in terms of, if I look at the correlation between the anticipated increase in compliance budgets and the focus on implementing systems, I would be drawn to the conclusion that yes, but maybe that's not the on-the-ground experience that you live and breathe every day.
Yeah, so what we experience is that there is not necessarily an increase in the request. This is to find a new solution, for example. Very often we see many organizations are well advanced and good positions with a compliance culture accepted by all employees, with compliance systems in place. And now we see more a trend that to improve the automation level means to add more automated processes, to adopt new technology, to add more value to the analysis itself. But again, it all turns from our point of view out into, is the organization well prepared from an infrastructure point of view? And what is the idea and the plan to respond to regulatory changes? And these are the main two drivers: digital infrastructure and the digital response to regulatory changes.
Thank you, Stefan. And interesting, I've just posted the results of the third poll. Interesting to see the contradiction between what we can read in the media and certain reports versus the experience of the audience members. I think that the two questions now have been posted into the chat as well, so do please contribute on that. And before we move to the conclusion, I'd also like to close with the final polling question. And this is in relation to the budget. So what I have seen and read is that there has been an increase in compliance budgets across the board from 2019 to 2020. My question to you is, has your compliance budget increased substantially since 2019 to 2021? With all of the points that we've made today, I think that I would expect to see a yes majoritarily there, but let's not give it away for the minute. I'm seeing a big yes there, so that's very good to see that what has been published by various different reports on the focus areas and the budget increases for compliance seem to be the trend that the audience is also experiencing. So, Sarah, I'm not sure if there's any Q&A from the audience before we move to a last thoughts. And if not, what we'll do is we'll move to last thoughts. So maybe, Chris, in terms of the many different points that were raised today, what would be your outlook for the remainder of 2021 and, more importantly, 2022 and beyond, in terms of the compliance landscape and the operating and execution model that the clients have to deal with?
Thanks, Lisa. I think the core message here is that home working and the blend between private and public life is here to stay. We're not all going back into the office anytime soon, and that means that firms will have significant challenges. The regulatory regime continues to apply, and firms are going to need to find a way to make sure that they comply with the regulatory regime, but also respect their staff and respect the fact that their staff are trusted professionals. And the regulators themselves, I think, albeit slowly, are also adapting their regulatory approach to the new environment in which we're in. And that's actually quite a welcome thing.
Good, thank you, Chris. Heike, with all of the challenges that you have in terms of execution and implementing your operating model, how do you see the evolution of the future of the work from home, personal, professional synergies that have come upon us quite quickly with, obviously, the pandemic?
Well, we run a mix of office and work at home, and that works quite well, actually. I think for the more creative work, building up something, you actually need to meet in person. But actually, it's quite good to concentrate, sometimes even better from home, and we alleviate that in the proportion of meeting in the office. And I believe that's how it's going to stay. We will not go, I agree with Chris, we will not go back to 5 days a week in the office.
No more our partial commuting, which I'm sure a lot of participants are happy to hear. And Stefan, from a solutions angle, how do you see the future shaping up?
Yeah, so the main driver is really cost, to get the cost under control. This means automation, digitalization. I think our customers will also adopt some parts of the business model. And key is really here from the beginning to automate as much as possible. And this is really what we see as the trend, the automation and an infrastructure that is able to cope with all the changes that will come. From a data volume perspective and from a solution point of view, a flexible way to analyze the data required to fulfill regulatory requirements.
Thank you, Stefan. And I just want to wrap. I thought it was quite interesting that the remarks that you see on this summary slide are from Julia Hoggett again, in a speech that she gave, the first of 3 MAR speeches while she was at the FCA. And this one dates, it's the first speech in 2017. And it's remarkable how these 4 pillars are still very much relative to us in 2021 and beyond in terms of ensuring effective oversight, compliance. We cannot just stay still. We've seen that in the onslaught of artificial intelligence and even new ways to communicate. Chris cited WhatsApp. And the manner in which the FCA, but I think Chris really alluded to the fact that all regulators are being proactive and open-minded in this new paradigm that we find ourselves. And that market abuse impacting is only part of the puzzle, right? When we look to resolve for compliance, that this should not be viewed as a unique or treated separately. It should be looked at as a holistic view to ensure that the markets operate in a clean and efficient manner. And then lastly, to leave you is trust. I mean, trust is essential in any society, and Julia puts it very well in terms of it's necessary to ensure that markets function well and efficiently. And Chris definitely outlined that as well with some of the recent cases on the trust that the individual investor puts in when they see something on Instagram and then put their money behind it. So trust is really key. And also, Heike, you mentioned trust with regards to working from home, managing the staff from home, managing projects, and ensuring that the individuals are empowered to be able to execute on their mission to maintain the oversight on the compliance and regulatory obligations. So thank you all. I believe we're over time. As I mentioned at the opening, there will be opportunity if you're interested to understand better the data services that Refinitiv provide through the solutions providers and partners such as bNext in follow-up sessions. Thank you all, and I wish you a good afternoon.
Thank you very much.